and welcome to your Monday Futures Market Outlook for October 12, 2010. This is Patrick Sresna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict every bull and bear market cycle that the market has gone through. About a year ago, we crossed bullishly above the 80-week moving average, but we still have not changed our primary thesis from the bear market as of January 2008. The reason we still are looking for a little bit more information at this juncture, what we couldn't rule out at the time was simply the fact that the market was retracing before another leg of a bear market on the downside. And while that was certainly a risk, at this stage it's becoming more and more likely that there's going to be a bullish resolution to this weekly chart, which is that we found a short-term low at the end of the summer there. And even though we are, when we go to the daily charts, you'll see that we are at risk of a profit-taking cycle in the short term. In the bigger picture, we may be beginning a year-end rally into the early part of next year that may see 1,300, even 1,350 on the upside of the S&P. We'll discuss more as we turn on to the daily chart here. So when we look at that daily chart of the S&P 500, we more or less put in a low back on the last week of August, and subsequently have spent the better part of entire September rallying higher without any real corrective patterns along the way. We had an upside target at 1170, 1180. We now adjusted it to where the consolidation highs all occurred around that 1165 area, a few points lower, and that marks off the high zone of where the rally after the flash crash came in, and subsequently there is a measured move on the upside, also indicating this as a significant overhead resistance. We started off this morning with some early selling pressure on the downside. That doesn't necessarily make a reversal pattern just yet, but with the type of price action that we've been seeing here, it certainly is natural for us to at some stage go through a profit-taking cycle. Now, profit-taking cycle would be looking for an indication that it has begun on a break of that 1145, 1150 area on the downside. That has marked the highs and lows of a number of different days over the last 2-3 weeks. Any significant break below there would give us some sort of an indication that the market is going to profit take. Our first downside target would be the 1120, 1130 area, and it would be a very good accomplishment for the bulls to contain all selling to that downside level. If we see profit taking get down there and consolidate over the course of a week, and then subsequently find very good support lines, that would be the springboard from which another significant leg of a rally would begin off of that support line. Now, a much deeper retracement on the downside could theoretically even go as deep as the 1090 level on the downside, but that doesn't necessarily mean that we're going to see that. Again, what will be critical during any profit-taking cycle here is the speed and the magnitude of which the selling comes in. A one-day sell-off, a very aggressive sell-off that finds big support lines the following few days, it would actually be a very good sign. But if we see continuous selling pressure coming in and key technical levels being broken very easily, that would give us the indication that that the market may have a much deeper consolidation going. But our first target is simply that this is just going to be a very natural, fast profit-taking cycle that holds the 1120, 1130 that will emerge as a buying opportunity. To review our key points, our thesis since January 2008 was that we're in a secular bear market. We're on the verge of shifting that bullish, and particularly we want to see those support levels hold for us to officially change our thesis to a bullish one for the remainder of the year. We've completed and exceeded a measured move to the upside last week, so it would be we remain positive on the market, but recognize that a profit-taking cycle would very naturally happen off these levels. If the bulls defend the support lines during that profit-taking cycle, it will actually be a buying opportunity, and we'll start focusing on the year highs for upside targets at that juncture. So investors can cautiously start to commit to the market, particularly during these profit-taking cycles. Next here, I want to take a look at the NASDAQ 100, and we are actually already consolidating at the year highs up around that 2030, 2060 area on the upside. This may be on the verge of being something that resembles a double top up along the upside. The confirmation is a break of the midpoint low of the double top, which would be a break below 1960 on the downside. That would indicate that some sort of a short-term high is in. Again, similarly to the S&P, if we had a profit-taking cycle occur on the NASDAQ, we'd be looking for that profit-taking cycle to work its way lower down toward those highs that came in around the 1910 and 1930 levels. That would be a very good place to see a low. A much deeper retracement could see even as low as the 1860, but again, we're not looking for this to be a very deep retracement. It would be very natural for any profit-taking cycle to not give a very big window for people to get back in. It's very natural for during major rallies for them to really not give other traders or investors opportunities to get in on a second shot. So usually profit-taking cycles are fast, quick, and then start to rally aggressively afterwards. So we'll be watching where and how low one of these profit-taking cycles goes. Next year, I want to take a look at the U.S. dollar index futures, and this is really one of the reasons why we actually think that there's room for there to be a profit-taking cycle in the markets. The dollar index has been very aggressive on its selling, and which has strengthened a lot of commodities and continued to be an underlying pin for which the whole market has been able to rise and use as an anchor to continue moving higher. But we've now hit our first downside target of the 77.78. That was what we were targeting last week. At this stage, we not only got down there, we had a number of stalling candles, but I've now got two good strong reversal candles coming off of that zone. If this marks the dollar index swing low and we see a rally up toward the 79.80 level on the upside, that may very well be the catalyst from which the market needed for a profit-taking cycle, not only in the commodities but subsequently in the market. So you can watch that dollar index as a cue. If we continue to see strengthening in the dollar index, it would probably continue to support the idea that the S&P is going to go through that profit-taking cycle at this stage. Next year, I want to take a look at gold futures, and we had an upside target in gold at the 1340 and the 1380 area on the upside, marked off in a zone like this over here. Really, at this juncture, the gold futures have now finished almost all measured moves on the upside. Now, that doesn't obviously mean that gold has to officially stop here, but this is really where a lot of traders are targeting all their upside moves for gold. And that doesn't mean that gold, after a very good profit-taking cycle, can't make and push toward 1500. But really, at some stage here, we're going to want to see some sort of a flag or wedge forming on the downside, especially if that dollar index rallies. And this should be and mark off where gold begins one of these profit-taking cycles on the downside. So we really want to see a U.S. dollar rally, gold profit take, S&P profit take, and all of those find key support lines over about a 1 week to 2 week consolidation. If we see that kind of a cycle overall occur, that could actually be the perfect type of consolidation to allow new risk-reward trades to be repositioned in the markets and new opportunities to really emerge from there. Next year, I want to take a look at crude oil, and we had the 81.83 focal point, which are now adjusted higher to the 82.84. We were really watching those highs that came in back in August, but really at this juncture, it's clear that oil is now consolidating that upper end of that zone in this 82.84 zone. Again, this is quite related to that dollar, so you can see those stalling candles here look very similar to the type of stalling candles we see on the upside of gold as well. So if that dollar index really here hits that low bottom and starts to bounce, then we could see a full retracement lower on oil. We'd be targeting a zone in the 76 to 79 zone here. Obviously, the top end right around that 78, 79 would be a perfect place for a short-term low to come in on oil. If it was, then that would be a perfect place for a springboard move to retest the highs up at the 86, 87 by November. But really, at this stage, what we want to first see is a good profit-taking cycle that recreates new buying opportunities on crude. Finally, I want to take a look at the 10-year Treasury note, and this certainly has got everyone's attention quite a bit, is the fact that we now have historical lows on the yields, and as well with these 10-year Treasury notes now breaking to higher highs. We continue to see strength in this area. The upside measured moves are around this 128 to 131 level, so we're already completing what we call the minimum measured move. Recognize that at the tail end of rallies, the last legs of the rallies tend to be shorter than the previous ones, so really we would be targeting more the 128, 129 zone rather than a full move on the to the 131. Especially with yields this low at some juncture, it would be very natural for the bonds to just not have that momentum push to make that all the way to that top end of that move. But nonetheless, we'll be watching what for stalling candles and other formations to start forming up in the next point higher on the upside on these Treasury notes. That was your Monday Futures Market Outlook. Thank you for joining me.